Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate filings. And today we've got quite a showstopper for you, because sometimes when a company talks about a merger, it's not just a simple handshake, it's more like a full-blown corporate drama. And we're about to dive into the script. Get ready, because Warner Bros. Discovery is making some massive moves, and it involves a price tag that will make your eyes water. We're talking about a deal that could redefine the entertainment landscape, and we're going to break down exactly what it means for everyone involved. Alright, so the big news is that Warner Bros. Discovery, or WBD as they're commonly known, is entering into a merger agreement. This isn't just any deal. This is a huge one. They've signed on the dotted line with Paramount Skydance Corporation, and they're bringing in a subsidiary named Prince Sub Inc. to handle the technicalities. The plan is for Prince Sub Inc. to merge with WBD, and WBD will then become a wholly owned part of Paramount Skydance. This is a pretty significant shift in ownership and structure. And before you think this is just a backroom deal, both WBD and Paramount Skydance's boards of directors have given this their unanimous stamp of approval. That is a big deal in corporate land. The WBD board is even recommending that their shareholders vote yes on this merger. So it looks like the leadership is all in. Now, for the part that probably everyone wants to know, the money. If all goes according to plan, for every share of WBD common stock, shareholders will get $31 in cash. But there is a little twist. If the deal closes after the 30th of September of 2026, they'll also get something called ticking consideration. Think of it as a daily interest payment that adds up the longer the deal takes past that September date. This provides a nice incentive to get things done relatively quickly, but also compensates shareholders for any delays. What about the folks who have stock options or restricted stock units, those equity awards that employees get? Well, for vested options, they'll be cashed out too. The amount they get is basically the difference between that $31 per S-hair and their exercise price. If the exercise price is higher than $31, then those options are basically worthless in this deal. For unvested equity awards like stock options and restricted stock units, they're going to be assumed by Paramount Skydance, but they'll still be subject to their original vesting schedules and conditions. This means employees will need to stick around and meet certain milestones to actually get paid out on those. It's a way to keep key talent engaged during this transition. The agreement also lays out what each party promises to do and not to do before the deal closes. WBD has to keep running its business as usual, but they can't do certain big things without Paramount Skydance's say. And importantly, they can't go looking for other deals or even talk to other potential buyers, unless there are some very specific exceptions. That is pretty standard in these big merger contracts to prevent a company from jumping ship. Now, let's talk about debt. WBD has some senior notes outstanding, and this deal has a specific clause related to them. Paramount Skydance has the option to request WBD take certain actions concerning these notes before the 15th of October, 2026. This could involve trying to change the terms of an exchange offer, which is basically a way for WBD to buy back its own debt, or even making a payment of $100 for every $1,000 of debt. This whole chunk could cost up to a whopping $1.5 billion. So they're definitely looking to manage their debt load as part of this merger. For this deal to actually go through, several things need to happen. First, WBD shareholders need to vote and approve the merger. That is a pretty standard step. Second, they need to get the green light from various government bodies and regulatory agencies. Think of antitrust reviews and things like that. And third, there can't be any legal orders stopping the deal. These are pretty common hurdles for any major merger. Now, how is this massive deal being funded? Get ready for this. They've secured about $46.7 billion from the Lawrence J. Ellison Revocable Trust, which is basically Larry Ellison, the Oracle guy, and his trust, plus another $250 million from Redbird Capital Partners. These are called PIPE investments, which stands for Private Investment in Public Equity. Essentially, big investors are putting in a ton of cash to buy shares of the acquiring company, Paramount Skydance, to help fund the deal. Larry Ellison alone is putting in an eye-popping amount of money. And here is a crucial point. The deal's closure does not depend on them securing financing. This means they've already got the money lined up, or at least the commitments for it. That is a strong sign that they are confident in getting this deal done. Like any major agreement, there are also rules about how the deal can be called off and what happens if it is. If things go wrong, either party can walk away. WBD can call it quits for various reasons, including if they get a better offer that they deem superior. In that case, WBD would have to pay a company termination fee of $3 billion. Ouch. On the flip side, if the deal is terminated because regulators block it, Paramount Skydance has to pay WBD a regulatory termination fee of a massive $7 billion. That is a huge number and shows the risk Paramount Skydance is taking on if approvals don't come through. And what about that massive check from Larry Ellison? Well, the Ellison parties, including Larry and his trust, have also provided a guarantee to WBD. This guarantee covers a lot of ground. It ensures the payment of things like the Netflix termination fee, the debt payment we talked about earlier, a whopping $45.7 billion of the merger consideration, and damages in case of breaches or fraud. This guarantee is designed to give WBD a lot of confidence that the deal will close, especially with such a significant amount of money involved. It's like having a very wealthy co-singer for a really big loan. Interestingly, this filing also reveals that WBD was in the middle of another major merger attempt with Netflix. They had an agreement in place, but it seems like this new deal with Paramount Skydance was deemed so much better that WBD decided to terminate the Netflix deal, and doing so wasn't cheap. WBD, with P-Sky actually paying on their behalf, had to fork over a $2.8 billion termination fee to Netflix. That is a substantial amount to pay just to get out of an existing agreement. It really underscores the scale and perceived value of this new deal. To top it all off, WBD and Paramount Skydance have released a joint press release announcing all of this. They're basically telling the whole world about the merger agreement, the termination of the Netflix deal, and that Paramount Skydance is also calling off its tender offer for WBD shares. This filing is essentially providing the official record of these significant events. Now, for the legal fine print, which is actually pretty important for investors, they're letting everyone know that this communication might be seen as asking for your vote to approve this merger. They plan to file a proxy statement with the SEC, and it is really important for investors to read that document thoroughly once it is available. It will have all the nitty-gritty details about the deal. They also provided links to the SEC website and their investor relations pages to get copies of these documents. This section is all about who might be influencing your vote. It tells you that WBD and Paramount Skydance, along with their directors and top executives, could be considered participants in asking you to vote for the merger. They're saying that information about these individuals is available in their past filings. Basically, it is a heads up about who has a vested interest in the outcome of the shareholder vote. And of course, no major corporate announcement is complete without a forward-looking statements section. Here they're basically saying that many of the things they're talking about today, like expectations for the merger's completion and its benefits, are just predictions. They are subject to risks and uncertainties, and the actual results could be very different. They list a bunch of potential problems, like regulatory hurdles, shareholder disapproval, or even general economic downturns that could mess with their plans. It's their way of protecting themselves if things don't go exactly as planned. Finally, we get to the list of exhibits. This is where they formally attach the actual documents that were summarized in the filing. We've got the agreement and plan of merger, the Ellison guarantee, and the joint press release. These are the full legal documents that back up everything we've discussed. And the report is signed by Gunnar Wiedenfels, who is the Chief Financial Officer of Warner Bros. Discovery. This is their official sign-off confirming the accuracy of the information presented on behalf of the company. So let's zoom out and look at this entire spectacle. We have Warner Bros. Discovery entering into a massive, eye-wateringly expensive merger with Paramount Skydance, backed by an enormous investment from Larry Ellison. They're ditching a previous deal with Netflix, paying a hefty breakup fee, and now they're all in on this new colossal combination. The sheer scale of the cash involved, especially that $46.7 billion from Ellison, is staggering. It speaks to a fundamental belief in the future value of this combined entity, even if it comes with significant regulatory and execution risks. The $3 billion termination fee if WBD backs out for a better deal, and the $7 billion fee if regulators kill the transaction, highlight the commitment and the potential penalties. What does this mean for the future of media? It is a huge consolidation. We're talking about fewer, larger players in the entertainment space. This could mean more streamlined operations, but also potentially less competition and fewer choices for consumers down the line. The strategy here seems to be about creating a dominant force that can compete with the likes of Disney and other media giants. The risk here, beyond the regulatory approvals, is execution. Merging two massive companies is incredibly complex, and the integration of operations, cultures, and of course finances is always a challenge. The fact that the deal isn't contingent on financing is a positive sign, but the devil is always in the details of how this monumental amount of money is deployed and managed. In my opinion, this is a bold, high-stakes move. Larry Ellison's massive investment is a strong signal of confidence, but the real test will be how well WBD and Paramount Skydance can actually merge and navigate the complex media landscape. The $31 per S-Hair offer seems like a decent premium for WBD shareholders. But if the combined company struggles to deliver, that premium might not feel so great in the long run. Alright, that is our breakdown of Warner Bros. Discovery's latest major move. What is your take on this colossal merger and what it signals for the future of entertainment? Drop your thoughts in the comments below. If this deep dive into corporate strategy and finance was valuable, hitting that like button really helps us out, and subscribe for more critical analyses of the companies shaping our world. Don't forget to check out our Discord community linked in the description for more discussions and insights. Thanks for watching, and we'll see you next time on Corporate Decoder.